Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. Wanted to kick off this year with a personal message to all of you, sharing some of our views on how we think 2025 might play out from an investor's perspective. But before we do that, and before I continue on, I just wanted to wish you all a Happy New Year, and I hope that you had a great holiday season and had a chance to relax with family and friends. Now, we know that 2025 is full of change. In a couple of weeks, we'll see a new administration in Washington. We just got through a recent event with the House re-electing Johnson to be the speaker again. So we know that political news and updates from our friends in Washington is going to be something that's going to be top of mind and top of the media stream in 2025. That's easy to project. But I think the thing that I think investors are really thinking about are that we ended last year with a gain of over 20% in the stock market. We also had in our portfolios a positive gain in our bond allocations as well as the two major asset classes in all of your portfolios between stocks and bonds. So I'm sure investors are wondering, and you all are wondering, can we have another year of positive returns from both stocks and bonds? And we believe the answer is yes. But there are some risks, obviously, to that outlook right now, because there is still a lot of uncertainty regarding some of the policy decisions that are still forthcoming over the next several months. So let's just talk about the base case for this year before we get into the risks that are out there. So we are expecting earnings to grow in the publicly traded equity markets by over 10% year over year. That's led again by mega cap tech, who has earnings outlooks for growth year over year of more than 20%. And again, stimulated by investment in artificial intelligence, software enhancement, and other productivity gains that the technology industry is bringing to market, both in just the hardware as well as in software and other tools. And we believe in this AI revolution, and we think that it is going to add to productivity gains for people and businesses over time, but definitely not all in one year, and it's something that's still going to play out over the next 5+ years. That's a big driver to market performance, we think, for 25, seeing gains repeat from those mega cap tech companies, but also we're expecting gains to be close to 8 to 10% from other areas or other sectors of the market, such as in the industrials, the healthcare, financials, other areas outside of tech. So our view right now within the equities market is volatility will definitely increase over the course of 2025. But as long as earnings is being delivered on a quarterly basis by publicly traded companies in a diversified way, we think the market has a chance to climb. Now, not to the same extent as 20% in 2020, I should say 20% or more in 2024. But we think this year it's possible for high single-digit, low double-digit gains, assuming companies can continue to maintain their profits, and also assuming the economy continues to chug along and consumers continue to spend. Now, that's a very simple base case there, and I'm trying to keep it simple to kick off the year. On the flip side, on the bond market, we know that interest rates have ticked up because the Federal Reserve has clarified that they're not going to cut interest rates as much in 2025 as previously expected. We heard this news from the Fed back on December 18th of 24, and we've heard some updates from Fed members of the FOMC over the last couple of weeks, reiterating that the economy is on stable footing, but they want to be data dependent and take their time with making any changes with interest rates or other aspects of monetary policy, because they want to see what's going to come out of Washington under this new administration, and they want to see what's going on with inflation, because it seems like inflation is kind of leveled off in the country while the economy continues to grow, and they don't think that the fight against inflation is over just yet. So we think that as the year goes on, the economy will slow because consumers are going to spend money, but again, not spending to the same degree. And we correctly forecasted that last year. It's just that the spending didn't drop as much as we thought or other economists thought as well. I do think that as the year goes on, consumers will continue to be price sensitive. The economy will continue to grow, and we should still expect to see inflation somewhere between 2 and 3% over the balance of the year. Now, as it relates to interest rates on the short end of the curve have a chance to be cut by 1 or 2 times over the course of 2025 from the Fed. But I think that's going to happen more in the second half of the year, or definitely more in that spring to summer to fall, perspective. And I think at the same point in time, as the economy slows, interest rates come down, inflation will come down. But the stickiest thing that's keeping inflation elevated is housing prices. So we're really watching to see how the spring into summer activity from the housing market goes, not only in residential, but also looking at activity in the industrial real estate sector, as well as other sectors of the real estate market. But specifically focusing on residential, it's all about supply coming to market. And if interest rates have a chance to drop over the next 6 months, maybe then we might see a little bit more supply, we might see a little bit more activity. But right now, based on some of the activity measures that are out there, it should be a pretty busy year in 2025 for real estate activities, with a lot of pent-up demand that exists within the system and the economy. Now, what's the risk to what sounds like good news for 2025 from an investing perspective? Because what I'm saying is stocks have a chance to go up in value, and also we have a chance to make money in bonds again. Well, the risks, as I've said before, are the policy mistakes, the policy errors that can come from our friends in the Federal Reserve, as well as our friends in Washington. So Federal Reserve, they mistime those interest rate cuts. They misread the economic data, and they cause the economy to slow down faster than expected, or inflation doesn't moderate and they actually have to raise interest rates. Now, what would cause that? I think the biggest driver are going to be policy decisions that come out of Washington, specifically Congress and specifically executive orders out of the Trump administration. And again, not to sound political, but when you think about all the different policy changes that were talked about over the last several months going into the election, and then after the election results, it seems quite confusing. There's a lot of conflicting variables. I mean, let's take the good news items, which are we know the federal government needs to rein in spending and get back to a fiscally prudent plan, kind of similar to what we saw in actions that were taken back in the 1990s, where we actually went from deficits to surpluses over 10 years. I'd like to see some of that happen in the future. I think most Americans would as well. However, since the pandemic, Washington has been hooked on a sugar bowl of spending, as we saw with the money supply increasing by over 40% back in 2020 and 2021. We got to rein that in. So we'll see if that helps to balance out some of the concerns about the economy longer term. But in the short term, if they cut spending, that could be bad for the economy. The other thing that could be bad for the economy is if tariffs go to extremes. Because if tariffs get triggered to these 60% levels everywhere, that's only going to cause prices to go up on the consumer. And we've already heard from companies that they're going to raise prices. And we've already heard from our trading partners around the world, Canada, Europe, China, for example, they're not just going to sit back and take tariffs from the United States. They're going to fight back in some ways. So this is going to be different than what we saw in Trump in their first administration. And so we'll have to keep an eye on that. And that's why I think, again, due to these uncertainties on federal spending, due to the uncertainties on tariffs, that adds to volatility. At the same point in time, how does the Fed react to any policies that come out of Washington that could impact inflation? Again, ties into their decisions. So again, adding to volatility. And then on the flip side, you have some good news items that can definitely happen as well. You can have deregulation that helps to support a more efficient economic system. You can have tax cuts extended or other type of tax incentives created to stimulate business. We're expecting more M&A activity to happen as well, which can unlock value for companies as well as investors. So as much as there are some puzzle pieces here that are to the negative, I can also find that there's a lot of puzzle pieces that can give you some positive economic results as well. So that's why I think this balancing act between what type of policy decisions come out of Washington, what changes come from the Fed regarding those decisions, and then how does the economy move through this? How does it affect the consumer, different sectors of the economy? And then taking it back to my earlier point, can earnings continue to grow? That's why these four major themes are the themes that we're going to be talking about over the course of 2025. And we firmly believe here at the firm is that if policy does not go to extremes and companies can still generate profits while the economy stays on stable footing, that's why we could still have a positive investing year for 2025. Now, we're going to get a lot more information over the next several weeks, especially as the new administration is installed on January 20th. So definitely look out for further updates. Definitely look out for other content that we're sharing along the way. But we will continue to keep you focused. We are not looking to take on exogenous risk right now. We're maintaining portfolio positions and staying broadly diversified across the board for you. So thanks so much for your time. Look forward to keeping you updated. Appreciate your trust and support, and obviously the privilege to be able to have a relationship with you to help yourself, to help your family, to help your business. So thank you very much, and look forward to a great year ahead.